Hey, what's up, my friend? So welcome to the ultimate candlestick pattern trading course, right? In this course, right, you'll learn how to identify high probability trading setups so you can profit in bull and bear markets. Now, some of you might be thinking, right, I'm new to trading, right? Would this help me? I have no idea about candlestick patterns. I don't know technical analysis. Don't worry, right? Because in this course, right, I'll walk you through step by step from A to Z, right, on how to trade candlestick patterns even if you have no trading experience. And by the end of this session, right, I can assure you that you will be able to trade candlestick patterns like a pro. Sounds good? Then let's begin. So now the first thing, right, to get started is what is a candlestick pattern? Okay, so a candlestick pattern is essentially a method, right, of reading a price chart. It originated back in Japan, right? That's the history. And the key component, right, of a candlestick chart is that it shows you four things. It shows you the opening price, the high of the session, the low of the session, and the closing price. Okay, so when I use the term session, right, it can mean different things, right? If you're looking at candlestick charts on a daily time frame, it means the high of the day. If you're looking at candlestick charts on the 1 hour time frame, it means the high of the 1 hour session. Okay, so it can mean different things depending on the time frame you're looking at. We'll cover that in more details later. So now, how do you read a candlestick pattern, or how do you read a candlestick chart? So remember, there are only four things: the open, the high, the low, and the close. So looking at this, right, you can see that the candles are usually typically two colors, either green, red, or perhaps it can be black, white, right? Sometimes you can even change the color if you want, but generally the most common color is green and red. So when you see a green candlestick pattern, right, it means that the price has closed higher for the session. So you can see that this is the opening price at this line over here. This is the opening price. This is the closing price. And when you see this black shadow over here, we call this a wick, right? This is the upper wick. This is the highs of the session. And this over here is the lows of the session. All right, this at this point over here. So likewise, right, on the other hand, the red color bar, the bearish bar, the open is at the opposite side. The open now is on top, right over here, the open. And the close is at the bottom. And the lows of the session is here, over here. And the highs of the session is here. So the main difference between a bearish bar and a bullish bar is that the open and close are at the opposite side. For a bullish bar, it means the price has closed higher for the session. The open is always below the close. For a bearish bar, it means that the price has closed lower for the session and the open has to be above the close. Okay, so now let's try to understand these candlestick patterns in more depth. So first thing, right, you'll notice that is that candlestick patterns, there are two main components to it, right? One is what we call the body. This portion here is the body, right? This green area. And this black shadow thing is what we call the wick, right? So the body pretty much tells you, right, who's in control. So in this case, you can see that the buyers, the opening price is over here, and the buyers push price up all the way up higher, and finally closing at this highs of the session. However, you can't neglect this shadow as well, because what it's telling you is that there is price rejection. There is, rejection of higher prices. Because if you think about this, right, this was once the highs of the session. So what this tells you is that at one point in time, the sellers actually pushed the price from this highs down lower, right, until the price closed over here. All right, until it closed over here. So if you think about this, right, this is actually a form of price rejection, right? Rejection of higher prices. So there are two components to a candlestick pattern, the body and the wick. The third thing that I want you to know is this, right? What is the size of the body relative to the wick? Because you can see over here again, you have just the wick and the body, but this time around the message is completely different, right? If you look at this candlestick pattern over here, it shows that yes, the price did close higher. The price opened here at this level and it closed over here, right? This is the close, this is the open. However, if you look at the wick, notice the price rejection, because at one point in time, right, the highs of the session is over here at this point. And the only way for the price to actually close at this level is that the price, right, has to come all the way down from the highs and then finally closing at this level. So what does this tell you? It tells you that yes, right, the buyers did push the price up slightly higher for the session. but there was an immense amount of selling pressure, a strong price rejection, right? That actually pushed the price lower during the session. So you can see that over here, this isn't a very bullish pattern. In fact, it's quite bearish, as it shows you that the immense selling pressure by the sellers. Okay, so I also want you to pay attention to actually these three things. Number one is the body. Number two is the wick. And number three is the body relative to the wick, right? The size of the body relative to the wick. Usually, if the wick is much longer than the body, it's a sign of price rejection. Okay, so this is how you read candlestick patterns. Just three components: the body, the wick, and the body relative to the wick. So moving on, right, let's look at a few variations, right, to candlestick patterns. So the first one, I think, is something that you are probably, familiar with. The price actually opened here. Open. Then it closed. This is the highs. This is the lows of the session. This is a close, right? I call it C. Then in terms of the meaning behind it, you can see it's quite straightforward. The price opened near the lows. It tried to come down lower, got rejected. Then it finally closed near the highs. At one point in time, it was actually at this level over here, meaning the buyers were at this level at one point in time, and the sellers came in, pushed price slightly lower, and finally closing near the high. So it's a sign of strength. How about this candle? You can see that the price opened here and it closed over here. So when the market just opened, right, possibly what happened is that the price came down lower. The sellers were in control. Then the buyers took charge and pushed price all the way back up higher, back towards this highs. And then finally the sellers came back in and the market closed at this price level. So generally the meaning behind it is that there is, indecision in the markets. Both buyers and sellers are present, right? And the market just inched slightly up higher. So if you ask me, generally this is what we call an indecision pattern. And if you look at this last candlestick pattern, right, the price opened here, market came down all the way down lower, sellers are in control. Then the buyers took charge and reversed back and finally closing near the highs. So the meaning of this pattern is rejection of lower prices. The buyers are clearly in control. Okay, moving on, right? Just the opposite variation. This one, I don't think there's much to go through. Right? It's just the opposite to what we have just shared earlier. Okay, this is the selling version of it. So now let's do a quick recap, shall we? A candlestick chart, right, shows you who's in control. All right. Remember, I said pay attention to the body, the wick, and the body relative to the wick. That is important as well, right? Because if you can have a bullish close, but then if your wick is much longer than the body, right, it's still a sign of price rejection. Okay? So moving on, candlesticks on different time frames. So earlier, right, if you recall, I said that candlestick chart can appear on different time frames, daily, 1 hour, whatsoever. And if you look at this, right, this is a candlestick chart on the 60 minutes time frame, right, which is the 1 hour. So you can see that this means that every hour, one of this bar will be painted, right? Every hour, this bar will be painted. 1 hour, this bar is painted. 1 hour later, this bar is painted. 1 hour later, this bar is painted. So a bar is printed on the screen every 1 hour. And if you look at this one over here, this is the daily time frame. Okay, see this over here, 1D, right, means daily, right? This means that every single bar is printed after a day. Okay, so Monday there will be a bar, Tuesday there is 1 bar, Wednesday there is 1 bar, and etc. So this is how candlestick patterns, right, can form on the different time frames. So now, I want to walk you through something what we call combining candlestick patterns, because candlestick patterns, they are essentially just showing you the price of the different sessions. And if you think about this, right, this can be combined, right? For example, let me share with you, right? If you look at this, right, just imagine that, let's say this is a 1 hour candle, right? The green one is 1 hour. Red one is 1 hour. So now, when you combine these two candlestick pattern, this one over here, what time frame is this candle going to be? Well, 1 hour plus 1 hour, this will be a 2 hour candle. All right, and how did this 2 hour candle come about? Very simple, right? A 2 hour candle simply means, right, it identifies what's the high over the last 2 hours, what is the low over the last 2 hours, the opening price of the first hour, and the closing price, right, at the second hour. Simple. So if you look at this, right, this is essentially the open, this is the close,